Hi, I'm Baxter with Fairway Independent Mortgage with your weekly market update. I hope you guys are having a great week. And I wanted to talk this week about a key number that came out that's released every single month called the Consumer Price Index. This is one of several gauges of inflation that are commonly tracked by economists. And the number came out at the highest number that we have seen in 13 years. It came out at 4.2%, which is a blistering hot number. And this is an indicator of what's going on in the economy right now, that there is inflation happening. I mean, if you're in the grocery store buying groceries, you can see that prices are going up in reality. And the Consumer Price Index is a gauge of what's happening for consumers out there. There's other ones that are more tied to industry and that kind of thing. But this is a direct indicator of what's happening for consumers out there, for you and me. So why is this important, and why is a mortgage person talking about inflation on a mortgage-related video? The reason why, and you might have heard me talk about this before, is that inflation affects rates. In an inflationary environment, in an environment where inflation is higher, we see higher rates. Those of you who can remember the 80s, remember we had really high inflation and also really high rates. Now, really high rates, it doesn't mean not all rates are bad. You see higher savings rates, for example, when there's high inflation. So your investments can do better. But on the borrowing side, you also pay more to borrow money when inflation is higher. So if you just look at it on a very simple, basic level, there's a lot more behind it, but I'm going to try to explain it on a basic level. If you think about inflation at 4.2% and you have a mortgage at 3%, there's an investor behind that 3% mortgage that's making a rate of return. It's not around 3%, but for the purpose of our argument, I'm going to say 3% is the return that investor is making on that mortgage. Why would they want to invest and make 3% if that money is being reduced in value by 4%? Basically, they're losing 1% per year because inflation is more than the amount of money they're making on that investment. So this is why in an inflationary environment, rates tend to go up. Now, it's not where it's immediate, where rates go way sky high right away or anything like that, or that rates even will go sky high. I'm not trying to say that, but if this trend continues, it's likely that rates are going to climb up. And we've seen a little bit of an increase here this week. So it's just something to be aware of going into the summer. And if you have not yet refinanced, rates are still at historic lows, and you can save a lot of money. And if you're looking to maybe pull cash out for a remodel or to pay off some other debts, now is the time to do it, to seize these lower rates that we still have, because low rates like this can't continue forever. So that's just a little bit about this key thing that's going on in the market. And if you have questions about your particular scenario or anything else loan related, we're always here for you. So just call, text, or email. Once again, my name is RJ Baxter, Fairway Independent Mortgage. Have a great rest of your day.